Thank you once again for joining me. We are going live with another NFP registration, and we're seeing what the monthly job role report will be for America. So this is November's job report, and we're looking at November's data in December. So obviously it's 1 month behind. So thank you very much for joining me. For those that would like to have the chance to ask any questions while we're having this live webinar, please feel free to do so. I'll be joined shortly by a special guest, Daniel, who will also take us through his version of events for the NFP, but not only for this time around, as we get into the rest of the year and beyond as well into 2023. So just to kick things off, my name is David. I'll be taking you through for the next NFP engagement to see what the possibilities are in the markets, where we've come from as well, and what the figures are, the most important figures such as retail sales, ADP data, and job reports as well. So as I said, thank you very much for joining me, and we'll see what we are looking at this time around. So looking at the NFP trading session, we are seeing at the moment that the jobs market has really been quite difficult to call. I just want to go on to a quick risk disclaimer before we go into it, because I just want to let you know that this is my personal advice and also my personal opinion. So, we have to make sure that don't take this literally, because the results could go in a different direction. So foreign exchange trading and investment in CFDs can be highly speculative and may result in losses as well as profits. Foreign exchange and derivatives trading is not suitable, for many members of the public, and only risk capital should be applied. This webinar is provided for information purposes only, and no information contained herein constitute a solicitation for the purpose or purchase or sale of any commodity, security, or investment, nor should it serve as a basis for any investment decision. Orbex Limited does not guarantee the accuracy or completeness of information or analysis supplied. So that being said, like I said before, feel free to ask any questions if you're looking at any particular markets, and if you're looking to see what is going to happen for the NFP numbers. So it's been a little bit downplayed since Jerome Powell a couple of days ago did say that he would be easing this this inflation rate hike at the moment, and we're looking for inflation to start coming lower because of that. 7.7% at the moment, and it did reach up to 9.1% in the summertime. So we'll see what happens with that as we go on. Like I said, though, for those of you just joining us now, we will have a special guest speaker, Daniel, joining us shortly. And thank you very much for joining me. My name is David, and I'll take you through this NFP journey for the next hour or so. As I said, any questions that you want to ask, please let me know. So looking at the previous data and up until now, we are expecting a slight decrease from the jobs numbers this time last month, roughly about 60,000 jobs. But it is a little bit of not so much of a concern, because 200,000 jobs added is actually quite a good number. It was a good number before the pandemic. It's just been quite high recently because we want more people back into jobs for those positions to be filled as well. And if we look at the journey of the NFP for the last year, as you can see here, the 714,000 that we saw was just after the Christmas period in America, the holiday period. So naturally, there was more jobs filled in that particular time. But since the summer, and actually since the last reading of 261,000, if I bring your attention down to here, it has been the weakest since December of 2020. I'm just going to go through a few slides, not too many, because I don't want to get too boring with the slides. I want to go straight onto the markets and the charts as well, and answer any of your questions that you may be seeing. So just going to look through a basket of the main currencies and gold, looking at the Dow as well. The Dow and the NASDAQ really starting to push higher since the Federal Reserve Chairman Jerome Powell did say he would be easing the hikes in rates for the next meeting on December the 14th. So keep an eye out for that. It's only a couple of weeks away. We are expecting quite a big move on the dollar. So the dollar has been very weak in the last few sessions, and we're seeing now what can be in store for the dollar, and not only that, for gold as well, and most of the big currencies that we look at. So as I said, looking at the previous readings, we had this over 500,000 in July's reading, but since then it has been very subdued, 200 to 300,000, not really good jobs numbers for America. But saying that, like I said just a few minutes ago, before the pandemic, it was a very good jobs number. It was decent. There was still a growth in the jobs labor market. So we're seeing now what is actually looking to be quite good for America getting back in the swing of things as well. So just a few other slides just to go through, because I just want to grab your attention for the main benefits of the NFP, and not only the NFP but the dollar as well. Where is the dollar heading to as we not only close out quarter 4 of this year but the whole year as well, moving into quarter 1 of 2023. So US weekly jobless claims point to slightly tight conditions in the labor market as they hover just above the 200,000 mark. But this is a week by week jobs report, so it is coming in thick and fast, not like the NFP, which is on a monthly basis. So as you can see here, just over 200,000, ranging roughly about 220,000. We did have a spike up to 240,000 last week, but since then it has come down to just over 220,000. So quite a decent jobs number in that respect as well. So we are looking to see what is the next movement for the weekly jobless claims. But the big news that you can probably get into that's really been hitting not only the American dollar but most economies over the world is the fact that inflation is running high. Especially in Europe, America, we had 9.1%, the highest in 41 years. Now we are looking to see a slight gradual decrease, like the Fed was predicting. This is why it was hiking its rates so aggressively, 6 times in a row actually from the beginning of the year. So really, really aggressive Fed hikes there. And because of this, we are now looking like the Fed will start easing off because we got to 7.7%. The terminal date for hiking rates is supposed to be between 4 to 5%. So it is getting to that kind of area at the moment. But tell me what you think with the Fed. Should they start cooling off, or is aggressive action possibly going to be in the future? So we've had 4 readings of 75 basis point hike rates at the moment, and we are looking now at half a percentage point, so 50 basis points in the next reading in December the 14th. So if that happens, will we see more of a gradual slowdown in this inflation, or will inflation still be quite heightened? Let me know what you think and what you're looking at as well. So like I said, 40-year high, 41-year high, 9.1%, and then we started to come down 8.5, 8.3, 8.2, and finally 7.7%. We'll see what the next reading is shortly when it does come out, but it is looking quite good for America. Better than Europe, which was at 10.1% at one point. So double-digit figures for Europe for the first time ever. So it is actually on the back of the euro. And you have to think that with Europe not having Russian oil and gas by the end of this year, will we see quite a weak European euro and a British pound as we go into 2023 as well. So the final slide of today's presentation, as I said, don't want to get it too boring. I want to get straight on the charts and see what we can sink our teeth into with the movements in the market. We're looking at retail sales. They did surge over 1% for the first time. 1.3% for the first time if you go back all the way to the beginning of the year. And this was obviously during the holiday period for America. So this was kind of like a standard thing. Obviously, we've had Thanksgiving as well. That we've just the season that we've just had. So there is a little bit more retail shopping, but is it enough to get America back on the front foot? If you can see here in July's data, we went on a negative territory figure, and it was quite subdued at 0% the last time around. So 1.3% is a very good number, even though the figure was supposed to be only 0.7%, so it's quite a big reading, big jump in that respect. Private businesses, though, very subdued. It's actually their least since January of 2021. 127,000 new jobs only in the private sector industry. And if you look in the middle of this year and towards the beginning, we were very, very healthy on this number, way above 300,000 for most of the first half of the year. But since then, we have had very, very dismal readings on ADP data. So will this come into effect? And will this affect not only the NFP numbers, but also if the American economy is getting back on track as well? We'll see what happens in that regard. So let's just get on to the chart. So I've been looking on these. I've put it on the daily chart first of all. So I just need to share my screen as well. That will probably be a lot helpful. Sorry about that. So we're looking on the daily chart as well. We are seeing at the moment that we are looking very, very buoyant at the moment. Just had a request to look from gold. We'll look at from gold straight away, because on the daily chart, what I was looking at the moment is this triple bottom on gold, which was really, really good, because when we get a triple confirmation, We are seeing at the moment that gold is now hitting this 1800 handle, and 1800 handle is not only quite a good psychological area, but it's the last time we had a proper swing high in the market. So at the moment, it is looking like it's going to consolidate slightly, but we could still have a move to the downside. Whether or not we break 1800 and confirm, this will be the big test in gold, because we'll see then if prices will start moving higher. So what we want to do now is basically look to see at this particular area if we're going to start moving higher, and then get to these previous levels here, roughly about 1870, 1860, something like that. With gold, it usually jumps in about 10 to $20 hikes or depreciates. But at the moment, we are seeing now that gold is really starting to push higher. It was very, very predictable that we were going to get to 1800, because the last time I did an analysis on my webinars, we moved to this particular point here, which was roughly about 1780, 1790. We took a slight correction, but because we failed to go past the previous high, it was very obvious that gold would start moving higher, roughly about at this particular point up to 1800. So now, just to answer your question, Nikhil, we are seeing the next signal for gold is that it's going to hit a little bit of resistance now. If we put it onto the 4-hour chart, for example, as you can see, nicely consolidated at the moment, and then we could start moving a little bit lower in the near term at least. So we're just seeing now if we do get that big resistance on gold, we could start moving lower. So depending on the NFP numbers, depending if there is a big number on the NFP, will determine if gold does have a little bit of a rocky afternoon. But in the near term, at least for the next week, if we take away gold, NFP, if we take away the big fundamental news events, we'll see if the psychological advantage of bulls in the market is going to deplete, and then we're going to start moving a little bit lower. So let me know what you think about that. In my opinion, is that we're going to see a heavy consolidation now, and possibly a move lower for the near term at least. For me, if we break this particular 1800 handle and hold above it, roughly about 1810, then we could see another move to the upside. So we'll just be looking at the next move in the market. So like I said, 1820, 1830, and then we'll see where gold comes from then. But keep your questions coming. Thank you very much for that. Wanted to get off so start off on the right foot with gold at the moment. We want to also look at the euro dollar. Now, the euro dollar has been very, very tricky in the fact that we were in a very, very bearish market for most of the year. We had this downturn, consolidation, downturn, consolidation, and you get the point, you get the picture. We were going in this direction quite a lot. But then we had the big turnaround in the dollar. We had quite a big move that meant that we penetrated parity for the first time. I'll just actually put that on the chart so you can see roughly where that is. So here's parity for the first time in quite a few years. And if we just zoom in, what I was looking at here is not only did we hit heavy resistance, roughly when was this? This was in the beginning of October. We started to move lower again. But as you can see, we were in a trending bull channel. And as you can see here, we got higher highs and higher lows, which meant that the trend of euro dollar is going to keep going higher and higher. Then we had a breakout of this particular channel. And as you can see now, we are trending above the channel, with the support line being the top border of the channel. So this is very, very interesting, because this gives me the impetus that prices will keep going higher. Just been asking on the 1-hour chart, just give me 1 second. I just want to just emphasize where we're heading for at the moment. So we're just looking now at the main big highs, which was roughly about the high of the 107 area. So if we go to the 1-hour chart, as you can see here, very, very bullish momentum at the moment. And we are in a very vast bull market, very, very recovering. And we are on the top above the 105 handle. So this is actually, if you just pull it back to the daily chart, this hasn't happened since the back end of June. So roughly it's been almost a 6-month high at the moment. So very, very good dynamic on euro dollar. And as you can see here, we're seeing now this very, very bullish run. We are expecting slight consolidation, but if even the consolidated areas, if you can see here, we are seeing now that even the consolidatory uh, candlesticks are actually in a bullish zone. So this gives me the impetus that euro dollar will continue to climb. This is because the dollar seems to have been very, very exhausted across the board, not only with euro dollar, pound dollar, dollar yen, the dollar index is moving the opposite direction. So we are seeing now a bit of a weak dollar just because Jerome Powell has said that he will start easing on his monetary policy and slow down on the rate hikes as well. So, but tell me what you think with that. As I said, I'm just putting on the daily chart to give you the overall picture. But because we are now seeing support at this top border channel, then it gives me the impetus that prices will keep moving higher. So what we're expecting in the near term, at least, is possibly another correction downwards and then another leg to the upside, possibly towards the 106 handle. And then we'll, as you can see here, very, very choppy in the near term, and we're expecting this to keep on progressing as well. So tell me what you think about that and what you're looking for as well. Want to just go into the Dow quickly. Now, the Dow had a lot of requests for the Dow in the last few trading sessions with a lot of clients that I speak to and traders. The Dow has made this V-shaped recovery look very, very easy. Since the last swing high that we saw roughly about middle of August, we've had a downturn, and then we've had this another upturn, completely recovered 100%. And now actually we've pierced this particular high. I'll just zoom in so it looks a bit easier to see. We've pierced this particular high, and we are now trading to see what the next signal is. Because we got a break and a confirmation, we are expecting another move higher. So the Dow seems to be completely recovered from where we saw it before and where it's going at the moment. So it has been very, very flirtatious to be trading with it. So let's say, if that's a good word, because we are now seeing what's the potential in the American market. We've had indices jump over 700 points, especially the Dow, since Jerome Powell did give his statement that he will be easing. We've had the NASDAQ pushing higher as well, and the S&P over 2% in one day. So this is a very, very good positive for the Dow as well. If we look at the 1 hour chart, as you can see, from when Jerome Powell did make his statement, we have actually jumped quite significantly, over 1,000 points, and it doesn't look like it's going to slow down anytime soon. Obviously, there was going to be a bit of exhaustion. This was a natural occurrence that the exhaustive part would start running lower. However, we are now consolidating, and not only that, we are seeing now what the potential is for the Dow in the near term. I just want to bring you to this point here where we are a little bit like the euro dollar. Even though seems to be in a slight consolidation, we are still moving higher, which is quite significant because we are seeing quite a bull run in these indices and these pairs as well with the dollar. Let's take a look on cable. Cable has pretty much been moving in the same direction as euro dollar because of the weak dollar at the moment. And again, it's in this bullish channel. We are now, if I just extend it a bit more, as you can see here, we're just waiting for this breakout of this channel. We'll just zoom in so it's a little bit easier to see. As you can see, we are now trying to just pierce this top border of the channel, ranging roughly about the mid 122. We don't have too many traders favorable in cable because they prefer gold, oil, euro dollar, etc. But I just wanted to bring pound dollar into focus in this NFP because it is having quite a big bull run, and because of that, we are now seeing what the opportunities are in the market. So it's all about opportunity. It's all about that next step in the market, and obviously the NFP does give us that signal because it is one of the biggest fundamental news events of the month. NASDAQ time. So NASDAQ, what I've been looking at the moment is I'm expecting still this V-shaped recovery. So I've looked at this quite a lot recently because the Dow, as you can see here, pretty much at the same time in the middle of August, we had this big swing high. And if we just go back to the Dow and go back to the daily chart, just zoom out. Again, middle of August, big swing high. Then we had this collapse in the index. And a little bit like the NASDAQ, we have now found some firm support. This looks like a little bit of a false spike here, but you can see firm support, and now we're moving higher. So because of this, we are seeing possibly this move to the upside again. We're having a slight consolidation at the moment. The big test for me is if we get past this last particular resistance area that we saw because the Nasdaq was trying to move higher, got heavy resistance, lots of sellers in the market, sellers attracting sellers, and then this collapse in the Nasdaq. So firm support at the moment. We are looking to see if prices will start moving higher. For me, this will be the particular big test, 12,750, approximately 12,780, roughly about there. And then we're going to start moving higher in the near term at least. This could take a few weeks to develop because the Nasdaq isn't really as clear as the Dow, in the sense that we have seen quite a good move to the upside. So with that being done, just going to see just 10 minutes away from the NFP. So stay where you are for the live interaction. As I said, I've got Daniel joining me shortly to let us know what his take on the events will be. Looking at the US index as well. So the US index, I have been tracking this for quite a long time because a little bit like euro dollar, let's put this on a little bit like euro dollar, we've had move to the downside, and a correction, downside correction with the index, upside correction, upside correction, upside correction. So you get the general point of where we're going in the American market. However, now bearish channel, and now we are looking slightly well, very, very bearish, because now we're looking now that prices have fallen out of this particular channel, exactly like the euro dollar. As you can see here, we've got a new bullish channel trading upon the top of this border, of this upper border. And with the US index, we are trading below now. So now we've got firm resistance opposite of what the euro dollar is doing. We are now are expecting a move down to $100. We're at 104, the mid 104 area. Another $3.50 isn't really too much out of the way of what we're expecting at the moment. So we'll see what's going to happen. Thank you, Firas. My analysis, I'm expecting a strong NFP number. Well, as I said, I'll just bring it back to my presentation that I was just showing you earlier. And we're expecting a decrease to 200,000 from 216,000. So we'll see what happens with that. But to let you know more information, I'm just going to invite Daniel now. Daniel, can you hear me?
Yeah, I don't know, is my microphone working? No, I often sometimes disconnects.
Yeah, I think we can see you and hear you. Thank you very much. I just had a
Awesome.
couple. Great. Thanks for joining me again today. Just had a couple of clients asking, do we expect a strong NFP based on the numbers that are coming out? We've got a little bit of a decline, but it could be a little bit deceiving, could you say? Like, even though it's 200,000, it could still be a strong jobs number.
Yeah, that's the thing. Last couple times they've estimated to be around a little bit above 200,000, and then it came in, closer to 300,000. So
Exactly.
the economists haven't been really good at the predictions of the last couple months. So it could happen. The conditions and the labor conditions haven't really changed all that much from month on month. The
Mhm.
amount of job openings has gone down a little bit, but it's still really high. So yeah, at this point, you really don't know what's going to happen.
Exactly, exactly. So we're expecting unemployment to remain kind of subdued, but in the last few readings, it's pretty much just gone up by a percentage point or something. Not really too much to sink our teeth into to get overjoyed about the unemployment rate.
Yeah, that's sort of the thing. Is one of the things that's kind of a little bit lost, I guess, in all the data is that the situation is a little bit different because you have that large number, this 10 million job openings, and there's only 6 million-ish people that are looking for work. And so
Exactly.
it creates a significant distortion. So you can get a large number of people getting work, but then the unemployment rate stays relatively the same. And so, prior to COVID, if you there's a the number of open jobs dropped by say 300,000, and you compare that to 200,000 jobs created, you would have a negative job growth, and that would be really noticeable.
Mhm.
But now, if you have 10 million open jobs and you lose 300,000 jobs, like we did last month,
Mm.
um, it's not really noticeable because there's just there's still 400,000, I mean 400 million, I was going to say, there are 4 million open jobs, and
Yeah.
to absorb that difference. So that's probably one of the I mean, not to really justify the economists all that much, but that might be one of the reasons why it's hard to really predict where the numbers are going. Though the other thing is, if I remember correctly, just recently the number of people the people who went unemployed for the last week increased, and it was sort of consecutive. So the number of people who are looking for work has started to slowly creep up. So that might lead to the slight increase in unemployment, and we might not get as good of a job number. So
Well, yeah,
that's the other side.
I was just thinking like this time around, because the job numbers are 1 month delayed because we're looking at November's data. Would you say when we get to January for December, there'll be quite a big increase like we did see at the 714,000? I don't know if you can see my screen, but because of the holiday period in America, obviously a lot of companies that are willing to pay a little bit more money for their staff during the holiday season to cope with the retail sales and everything, people buying. Would you say we're expecting a jump for the next round of NFP data?
Yeah, that usually is a thing, but also the Bureau of Labor Statistics, they average it out for and taking into account some seasonality.
Hmm.
And also, there's the thing that a lot of the major retailers haven't really announced significant increases in holiday workers that they're going to be
Right.
hiring. Amazon's still hiring the same number as last year, so that I mean, it is something that you could expect, but it might not be as big as normal for the period. But also the other thing is that you have that birth death adjustment that happens at the end of the
Sure.
year, which is
Yeah.
the thing that surprised us 2 months ago, I think it was. Yeah, must have been 2 months ago.
Yeah.
So yeah, that could also be another surprise there too.
Yeah, true. I just want to bring your attention to the charts that I was just looking at with the viewers just before we go live, just before the NFP comes. We had Jerome Powell in the week say, well, I would say
Yeah.
negative comments for the markets, but he did say there was going to be an easing of rate hikes in the next round on December the 14th, I believe, is the next meeting. Because of this, we've had a bit of a collapse in the dollar across the board. Just put you
Mhm.
onto the tile windows. So like we've had the euro dollar, as you can see here, start jumping quite dramatically. I'll just put that on an hourly chart so it's a little bit easier to comprehend. And also the dollar index is moving in the opposite direction. So it's given the impetus that indices are up because there's going to be a difference in monetary policy shift. But do you see the Fed really sticking to their guns and maybe, okay, easing off a little bit, but 50 basis points in the next round is still quite aggressive, would you say?
Yeah, I guess there were more people who were worried that there'd be another 75 basis points, but I think it's also
Mm,
kind of directionality because the Fed really has this reputation where they go all in one direction. So
yeah,
as soon as the Fed raises rates once, then they're going to go all the way until there's a recession. Then now the Fed isn't
yeah,
raising rates. Oh, now they're going to stop, and so that can lead to a little bit of extra reaction. But the thing about Powell's speech on Wednesday is that he kind of basically repeated the same script as he's always been doing. So I was a
yeah.
little bit surprised that everyone took it so positively,
Hmm.
but maybe that's why there might be a little bit of a correction like going because they might be able get to process the data a little bit better and but yeah, I think the thing really is that people are really focused on what's going to happen in December, and
Yeah,
if 50 basis points kind of leads to a topping out at 5%. So if you go 50% in December and then I think the next meeting is early February, then you do another 25 and then you end up at
exactly.
5%. So
Yeah,
before there was potential going above 5%, that got some people a little bit more worried. So maybe that's what it might have more to do with that than specifically the 50 that be coming at now everyone's kind of pretty much saying it's going to be 50 on the 14th, I think is that they have the meeting.
I think
The
so. Yeah,
Yeah,
yeah.
2 Wednesdays for now.
2 Wednesdays from now. And the other thing is that we've had these aggressive rate hikes, sorry, from the Fed. Would you say that there's supposed to be a terminal date or terminal rate at the moment, which is supposed to be roughly about 4 to 5%? So if we keep seeing inflation dropping, I think it's at 7.7% now. Do you think that the Fed could actually say, what, maybe enough is enough, and we can stop doing this?
Yeah, that's the thing is it's a kind of a debate whether they're going to raise rates and then they're going to keep them up there or they're going
Exactly.
to bring them back down. And I really wouldn't put money on that bet just yet. Maybe
Exactly.
maybe through the winter, because the if there is it depends on how bad the recession is, if there is going to be a recession, because
Yeah.
that can put a lot of pressure on the Fed to cut rates even if they don't want to.
Hmm.
And also, there's this theory going around that it takes about 1.5 to 2 years for monetary policy to actually have an impact on inflation. And so the inflation has been coming down because fuel prices have been coming down. Because if you look at the core rate, it's still really high, and it's come
Yes.
down a little bit. And so, but not as much. So that might, after all, the Fed really cares more about PCE and core than
Hmm.
the main rate, because the main rate's more political, and the core rate is the one that has more to do with the
True.
monetary situation. So I think that
Yeah.
would be probably more focus on that than saying, oh, the inflation has come down. Well, the inflation rate can go down another percentage point and still hit the core rate. So
Mm.
there's still a pretty big difference between the
Lots
inflation
to
rate
do
and
still. Lots to do
yeah.
still for the Fed. If you just look at the charts at the moment, you see that there's
Oh
quite big
wow,
sparks. We're looking at non-farm payrolls came in at 263,000 new jobs added.
yeah. Just as
S-
you said, it's gonna be
So the consensus was roughly about 200,000. So a good jobs report there, strong jobs number, which is why you're seeing quite a big jump on the dollar, the euro dollar, the pound dollar, especially. We're seeing gold slide a little bit, which is well, slight by $15 at the moment. So that's quite a big move for gold
Mhm.
for the NFP. Looking at, let's just take a quick look at the other figures. So unemployment rate stays at 3.7% as predicted. We've also got Canadian dollar news as well, but we'll go into that
Right.
shortly. So average hourly earnings as well, 0.6% versus 0.3%. This is month on month.
Right.
So
Yeah.
yeah, quite good readings. Year on year as well, average hourly earnings 5.1% versus 4.6%. So you would say it's quite a positive figure going into the new year.
Yeah, it seems to be. It also gives the Fed more room if they want to keep hiking. Particularly that average hourly earnings thing. They're saying that there might be more wage price inflation. That might be
Yeah,
getting the Fed's more attention after the next meeting, maybe.
this was the problem with the last month's NFP. It was because it was a not a bad jobs number. There was a fear that they will just keep hiking and hiking. Uh,
Yeah,
and this time around, we're seeing a similar scenario. So it could actually affect December the 14th, their their decisions then. So
yeah.
we'll see what happens, I guess. So how do you see 2023 playing out, Daniel? Because obviously this is the last NFP nut jobs number for the year.
Oh, right.
Next,
It's the end of the year
next,
already.
yes, it is. Had to check then. So going into 2023, obviously we're still probably going to, like you said, have some rate hikes by the Fed.
Yeah.
We're expecting not so aggressive 75 basis points like we have seen for the past four readings, I think, in a row. So do you see inflation keep coming down, hiking, slowly easing? And also, what could you give us a bit of a comment on what you think on the European scenario because of less Russian oil and gas by the end of this year?
Right. Yeah, that's kind of yeah, I mean, you really hit it there at the end, because that's kind of really the big thing is going to be, what
Yeah.
happens in Europe with the gas situation. So
Mm.
well, the Germans claim that they have enough to make it through till March, and then March is when they can then maintain their supply with their current capacity.
Yeah.
So it depends on how the weather is, and the weather is
True.
probably less predictable in the market. So
Yes, it is at the moment.
that's the other
Yeah.
thing. Yeah. So it depends if the Europe gets through without a significant price increase because of the increase in cost of fuel, then the you could have a return to a more balanced monetary policy going forward.
Mhm.
But then also you have the thing with the euro. The ECB started raising rates slower and behind the Fed. So
Yeah.
the European Union also has to, well, the ECB has to also catch up with the Fed. So you have that large drop in the dollar, led primarily by the difference in interest rates between the Fed going up significantly higher, while the ECB didn't move and then moved slowly. And so now
Mhm.
the ECB is starting to move faster, and the Fed is starting to slow down. So then that gap will probably start to shrink, which could then finally help the euro, and also presumably weaken the dollar. But then, of course, as we see with the NFP, the data might come out as unexpected, and that could lead the Fed to maybe return to 75 basis points. Not particularly likely at this point, but it depends if inflation returns.
Yeah,
Don't know.
sure.
Yeah.
What
So
would?
yeah,
Yeah, sorry.
sorry.
Go ahead. Go ahead. Sorry.
Yeah, no, you see, really the inflation data after Christmas, I think there's going to be a lot to do with how the Christmas sales went, and
Hmm.
so maybe the first half of January might be a good time to check back to see where things are, to see whether they're heading towards a recession or not, or whether the Fed might stick to its guns or
Mm.
cave.
Would you say that the ECB are paying a little bit of the price now for delaying raising, hiking their rates? Because obviously the Fed were the first big central bank at the beginning of the year to say we will start aggressively hiking, and I think the ECB delayed until maybe April or May, and even that was, I think, only 25 or 50 basis point rate hike in the beginning. Do you think, like we've seen? I'll just bring you back to the euro dollar chart, because obviously for the vast majority of this year we've seen this collapse in the euro dollar. Obviously we hit parity, we went through parity,
Hmm.
but like you said, now there seems to be a bit of an adjustment, because now the ECB are going to start aggressively raising, whereas the Fed are kind of going to cool off. So for the vast majority of 2022, would you say that the euro and the ECB have kind of paid the price for being a little bit slow off the mark?
Yeah, that seems to be the thing. I mean, the euro also had a kind of a reason to, because they're closer to the conflict in Ukraine.
Yeah,
But I forget, it was maybe 2 months ago, I said that we needed to look to see where the when the inversion with the inflation happened in the United States, because the United States had the inflation rate going up and Europe had the inflation rate going up, and then the United States turned around, and the
yeah,
inflation rate in Europe is still, well, it's still in double digits, and so that probably would be where the point of the euro would bottom out and start coming back up. The question is maybe the ECB can't hike as much as the Fed can, because there are plenty of European countries that have significantly more debt than the United States federal government does.
true, yeah.
And the other thing is that some of the debt, a large portion of the federal debt, is sort of internally. So
Hmm.
a lot of people point to how the United States government has this high level of debt, but most of that is to the pension system. So if the interest rates goes up, it is kind of a problem in increasing the amount of money that they have to pay to service the debt, but it isn't as big of a problem, say, that Italy has, where they owe the money straight out. And so that
Sure.
would end up being that might be more a higher like a lower ceiling for the ECB, which means that the euro might not recover as much. But then, of course, the Fed might also be the first one to start lowering rates, which could,
Hmm.
then you had the other dynamic. So I think it really depends on what's going to happen during the winter, and that we really don't know for sure until, well, the winter's over
The
in
winter's over,
March.
yeah, true. I think that's
Yeah.
what you touched upon there. A lot of economists need to understand. They do understand probably, but to take into account that it's a United States of America, whereas it's not exactly a United Europe of Europe,
Yeah,
where each
exactly.
country has its own debts, it's got its own plan to move forward. I think it was Hungary or another country that was opposed to stop Russian oil and gas. They did still want to buy it.
Yeah.
So you can see, and I think there was a couple of other European countries as well. So this is where it comes into that tricky situation where it's not a united Europe, it's a United States of America, but European states are very much divided, especially if you live here like we do.
Yep.
You know that it doesn't always go to plan. So with that being said, there could be a bit more of a downturn on the euro, would you say, going into next year?
Yeah, there's always that risk, because that the large difference in policy that you have between Germany and Italy, particularly, more is representative, because Germany is the biggest one that represents sort of the north, and Italy
Yeah.
represents the south. And so that you can even see that, to use your same example of the price cap. The southern European countries wanted a price cap around 60, and northern ones in the Balkans and Poland wanted a price cap around 30,
Mm,
and that's where they ended up not agreeing. They still haven't agreed. So
yeah,
that's a much bigger difference than when you have in the United States, where it's one president who decides
exactly.
whatever it is going to be. So yeah, it can end up be a little bit more complicated and makes it a little bit harder to predict where the euro is going to go.
Hmm.
But that gives us some volatility that we can trade on.
Exactly. Thanks for that, Daniel. So going into 2023, is there anything particularly you're keeping an eye on yourself? Any asset, instrument, or anything that you can probably just shed some light on? for
Oh,
yourself?
yeah, I'm really interested in some. Well, we're having sort of like a bear market rally going on in the stocks, and so I'm sort of interested in that period when there might be another downturn, depending on how the issue of the recession goes. Because
Hmm.
usually, when you have the Fed raising, the stock market goes down and the dollar typically goes up, and then at some
Yeah.
point the Fed's going to have to turn around, which is the infamous pivot. So the
Hmm.
question is, when is that going to happen? Is it not going to happen? That might have to. Uh, Probably maybe February, March would be the. I keep coming back to March as sort of like kind of a pivotal date. So I'd be
Hmm.
really looking at the inflation rate to see maybe the dollar is going to turn around at some point. We already saw this with what Powell said. When Powell gave kind of implied that the interest rate wouldn't be going up so much, the dollar really moved, and
Hmm.
so that might now with this data from the non-farm payrolls might sort of readjust, and then we'll see what happens after the meeting with the Fed, and then sometime during the winter there'll probably be another situation like that where it actually does turn around permanently. Well, not permanently, but for a longer period of time. So that would be something that I'd be particularly kind of personally interested in. Though I wouldn't recommend anyone necessarily train on me saying that because my mind isn't
Oh,
the
of
most.
course, yeah. No, it's just to get like another little bit of aspect of where it could be headed. I mean, in March, is that the first time for the earnings season as well for the first quarter, or
Yeah,
is that
the
around that
well, you
time?
get fourth quarter earnings season. The thing about this upcoming earnings season is going to be really long. It starts in mid-January and then lasts till the beginning of March, and then 15
Ah,
days later, first quarter earnings season happens. So it's like one whole semester, well, whole quarter of earnings. So it's a little
yeah.
bit slower, but then you get all the annual reports, and so that gives you kind of like a better idea. So I would kind of be particularly interested in sort of tech stocks because when the Fed does the reason that all the tech stocks have been going down primarily is because of what's been happening with the Fed. So when the Fed reverses, then presumably you'd have a reversal also in the tech stocks. And so
Right.
apparently Buffett has a similar idea because he's been buying a lot of tech stocks in particular. And he's got like 40% of his portfolio is Apple,
Hmm.
though I wouldn't necessarily consider Apple the best option for that because Apple hasn't dropped so much as other companies. So look at something that has a low PE ratio or something along those lines. But the holidays is a good time because the markets are quiet. Well, there's a little bit more volatility, but most of the big traders are off. It might be
Yeah.
a good time to go through your portfolio, see what's going on, and then have a better new strategy for 2023, because
Sure.
2023 most likely is going to be quite a bit different than the current year. This year's been sort of like the market's been going down and the dollar's been going up. Probably that's going to flip at some point in next year. Question is when, and that's always the $1 million question.
Of course, yeah. While I have you on stocks, I've just can pick your brain just on one subject. I'm sure
Mhm.
like the Elon Musk takeover of Twitter has probably been something you've been looking at in the last few weeks. Where do you see this playing out? Because he seems to be trying to save some money for Twitter by getting rid of the vast majority of people that work for them. But can you see Twitter being quite a favorable stock, probably possibly into next year?
Yeah, I think there's actually a good possibility that he'll go and relist it because one, he bought it at a relatively high price comparatively, but
Hmm.
also I mean, if he's actually managing to do what he's saying he's doing and intending to do, significantly reducing the overhead cost of Twitter,
Yeah,
then that could actually be a quite interesting stock to get back into if he IPOs it, and an IPO would be a good way for him to reduce the amount of debt that he acquired. $44 billion is sitting around. He
true.
has to come in and he has to keep paying interest on.
Yeah,
But that will take some time for people to get a little bit more secure or feel better about how he's actually running things, because one of the problems of having a private company is that now he's no longer issuing quarterly reports, and so we don't know as much of what's going on in terms of the financials. But before he took over,
yeah.
this is a social media company that was
Mhm.
losing money in the middle of a pandemic when everyone was on Twitter and buying stuff online. So
Yeah.
the there's something significant improvements in the financials that could be done.
Yeah.
Now we'll see if he actually manages to do it.
Yeah.
Different question, but is in the same direction.
No, definitely. It's good to get your insight because obviously you're into stocks and stuff and indices and whatnot, and you trade quite a lot during the earnings season. So it's good to know from your aspect what's happening. 'Cause obviously, it's probably one of the biggest takeovers we're going to see for a while, from the world's richest person into, like you said, a company that was losing money during the pandemic somehow. So yeah, it's
Yeah,
quite a big risk for him, but I guess. I would say risk, but being the having so much money that he is a businessman and he knows what he's doing. So I guess by making these redundancies, these unfortunate redundancies, he is actually got a bit of a battle plan for Twitter to survive for the next 10
yeah.
years at least.
Yeah, it'd be good to. I would find it. The problem with a lot of these social media companies, of course, is that social media is kind of fickle. We used
Mm,
to have MySpace was used to be dominant, and now no one has MySpace. So there's,
yes.
there's always
No.
that kind of relative risk that can come along. Same thing could happen with Facebook as well, because Facebook's doing that big thing of moving over towards the metaverse. Doesn't seem to be paying out all that well either. So what is going to be
Yes.
the next uh, social media company? But
Mm,
Twitter does have the cachet that pretty much all the politicians are on it, all the media is on it, and all the reporters use it quite
yeah.
frequently. So, as long as they stay there, then Twitter is most likely going to be really important, and so most people are going to want to be on there to get the latest of what's going on. So,
Mhm.
yeah, as long as that happens, as long as the crowd remains unfickle, which
Mm,
is always a tough proposition. I'll
it
see it
definitely
couldn't
is.
do it. Yeah.
Okay, great, Daniel. Well, that's all from the NFP this time around. Thank you so much for joining me. It's always good to get your take on not only what's we've seen for the past few months on the jobs market, but obviously what's going on, well, what's predicted to be going on into 2023 as well. And being at the last one of the year, it's always good to have that taste of what are the possibilities for the American jobs market. So thank you for joining me once again,
Thanks for
and
the invitation, Ian, as
no
usual.
problem. No problem. And I guess I'll speak to you again in the new year.
But yeah, if I don't see you till then, have a happy new year.
You too. And well, thanks again for joining me. And yeah, all the best. We'll speak soon.
Yeah, take care.
Bye now. Bye for now. Okay, so that was Daniel, our market analyst, and very, very good um, view on how the markets are playing out. He's more of a specialist in stocks and indices and things like that. But we like to obviously cover all our bases for the NFP. So let's just have a little recap on where the charts are going. So big move in the market really for the NFP. We've got the euro dollar. Not only has it moved over 100 pips, which is such a big move in the market, but it is actually pushing lower and remaining in that space. So very, very strong dollar. We did predict it. We did say from Firas when he asked me, we're expecting a strong NFP. We did expect a strong NFP, and you can see the results here. The Dow has dropped quite significantly as well, moving over 400 points. NASDAQ as well, quite significant. Gaps in the market for the US index, that's pushed quite high. Cable as well, pound dollar. We are looking, let's see, euro dollar was 100 pips. This is 130 pips. So a very, very strong move in the market. But let's end on gold because I just want to show you what the opportunities are now. So we'll just put it onto the hourly chart and just zoom out so we can see a fully fledged move. So like we said before we started looking at the charts, we're expecting this correction and a move lower. So as you can see, it did get that firm resistance at 1800, and now we are looking for a correction lower. Put it on the daily chart just to see the overall focus of gold. And as you can see here, strong resistance. We are moving down. I left this here on purpose to show you that I did seem that we were going to predict to move lower. It could be a slight correction before we test 1800 again and then start moving higher above that. And then, like I said at the beginning of the presentation, to see where gold will end up in the near term. So that's all from the NFP engagement this time around. Thank you so much for joining me. It's been a pleasure. Always looking to see what the next moves are in the market, especially for the NFP. This particular NFP recording will be posted on our YouTube channel, on our Orbex YouTube focus, and you're feel free to comment and get into conversations with me. As I said, I'll be online to answer any questions that you may have, or any queries that you may have about where the markets are going. Like Daniel said, we are looking for a bit of a recovery in the dollar market in 2023, a little bit of a drop in the Eurozone, especially due to the fact that Russian oil and gas will dry up for the Eurozone into the next year. And that could hamper a swift revival on the euro dollar quite significantly. So let me know what you're going to be trading on. Let me know what you are specifically looking for in the new year, and we can get to grips with what you're seeing at the moment. So from what I can see, the next NFP will be the first Friday of the new year, which is the 6th of January. By then, we'll have more fresh inflation data. We'll have a lot more knowledge about where the Fed is going as well with their basis point rate hikes. And also we'll see what is happening in the near term as well as we approach this holiday season for America. Will retail sales bounce? Will job figures bounce? Will there be more of an emphasis in the fact that we are looking now at the point where it's going to be quite advantageous for a lot of these big economies. So we'll get back to you with what is happening for the next NFP. You'll have that posted to you, and you'll be able to join me once again for the next round. So once again, thank you very much for joining me, and feel free to I'll be still online for a while, but feel free to ask me any questions. And good luck to you. All the best for the new year, for 2023. And as I said, feel free to ask us anything. So take care. All the best to you and your families, and we'll speak soon. Bye for now.